Dear colleagues, today we are gonna talking about financial statement analysis. Let us first know what we mean by financial statement analysis. Ward, in his books in 1989, said we need the financials analysis for planning and control, for planning the objectives and plan how to achieve to these objectives, to, and also for control to take any corrective action where necessary. طيب. The method to make financial analysis, there is two main methods. First of all, horizontal and vertical analysis, and second one, the financial ratios. Let us go directly and have an example. I have an example of El Jof Agriculture's Development Company. This is an Saudi joint stock company established in 1988 with a bid up capital of 300 million riyal. We're gonna to start to analyze this company. We'll start with the vertical common size statement of income. What we mean by vertical analysis, we take the income statement and all the items in the income statement we relatively related to one item, which is gross sales. Here it is, we can see this. All of this, we take the main items in the income statement: cost of sales, gross profit, selling expense, G&A, and net income. All of this related to the gross sales. All of this related percentage of gross sales. Why it's necessary to have a percentage? Because the amount is not give you an indication. If I told, for example, our sales expenses is 8 million, okay? So what? But if I told you this is 80% of our sales, this meaning something is too much, okay? So if we take this is just to, we have analysis of 5 years. Each year we can compare it with the gross sales. If we start with G&A, we're gonna to find it's okay stability. 4% for 2013 is 4% of the gross sales, total G&A expenses, okay. 2014 it's okay also, okay, stable. All the same with the selling expense, so far it's stable also. 12, 9, 11, it's okay. Then operation expenses or cost of sales, this is the problem here. We find this is increased. By the way, cost of sales should be fixed. If we take in a percentage, it should be fixed, because if the cost of the product is, for example, the selling price is 100 and the cost of sales say 80, so the cost of sales should be 80%. If I sold 1 million, it's 80%. If I sold 100, it's 80%. But in this case, it's increased. So this is 55%, then 57, 62, no action from the management, 64, no action, jump it to 76% of the gross sales. And all of this affect, of course, the gross profit, and finally affect the net profit, decreased from 30% decreased to 10% because of, here it is, the problem of the cost of sales. And this is give you indication there is a problem with the operation department or the purchasing department. Whether I buy with the raw materials, high prices, or there is a problem in the labor or in the machine, in the operation. The other point, I have to compare my figures with competitors, because maybe this is the market. So I have to compare my figures with the benchmark company. If I compare it with the El Morai company, well-known food company, I can find the differences. Here it is, as we mentioned, cost of sales, it's not stable, even it's decreased. What we mentioned, the learning curve. By the way, we learn each year, we learn how to minimize our cost. Here it is, it was in 13, it was 65%, then decreased 64, 62, 60, 60. This is the difference. But in our example, the expenses is increased. And the same as if we see the operating or gross profit, other expenses is the same, stable. And this is the main point here, the cost of sales. Okay. This is the vertical analysis. If we go through the horizontal analysis, the main reason for the horizontal analysis to see our growth rates. We are moving from year to year, from year to year, we are moving up. We take a base year. Here it is, our example, we take the base year is 2013, and then we check for every year. We take, we divided the sales of the year divided by the base year. Here it is. If we divide the sales of 2014 divided by sales of 2013, we find there is an increase of 3%, 15 is 8%, 16 is 12%. Okay, there is a drop in 2017. But this means we have a growth rate, we can say this. Here it is, this is the important for the horizontal analysis because it indicates finally there is a regression, not a growth, because of the cost of sales. Because if the sales here increased by 3%, the cost of sales increased by 5%, more than the sales, and here by 8, here by 21. Here there is a increase in the sales by 12, but the cost of sales increase more than the sales, it's 29%. This give you an indication. The final indication is regression is not a growth. We have a problem in the company. This is an indication that there is a problem. We should take a corrective action because our net profit is decreased, not increased by the years. The same, we're gonna to compare these figures with the benchmark company, which is here in Marai also. We're gonna to find that big difference. Okay, there is a growth rate from 100, there is an increase of 12, here 23, here 31, and the cost of sales, of course, increased, but it's increased less increase, of course, because of the price increase, but this increased by less than the net sales. You can see here by 70 is the cost increased by 70, but net sales by 23. The final result, of course, there is growth rates, and even they decreased the expenses to give final net income growth 9%, 26%, 40%, 56%. All of this give you an indication. Management should take a decision to see where the problem in cost of sales, whether the operation department or the purchasing department. Let us take the second method, the financial ratios. We're going to take only one example of efficiency ratios. Efficiency ratios, this is give you an indication of how the department is going well. For example, here, this is measure the marketing department efficiency. Here it is the finance. Here it is the marketing also and the finance, how they are working. For example, here give you indication that the marketing department fails to discharge the company's products because there is an increase in inventory turnover. Okay, so in this case, this means there is a production, but problem with the marketing can't sell the product. The same with if we compare trade payables with trade receivables, the surprise that the trade receivables turnover uh, is higher than the trade payables. This mean what? This mean to pay for our supplier, we have to borrow because we collect the money after we paid to the supplier. For example, here I paid I pay to the supplier after 34 days, and I collect money after 61 days. From where gonna to pay? This mean I'm gonna to pay from from the a loan, or I have to take a loan to pay for our supplier. So this is a bad indication of the finance department. They should work hard to minimize this and to increase this. If we compare also with the Marai company, we're gonna to realize the difference. You can see here they collect their money only after 20 days. Here they paid after 6 7 days. This mean what? This mean in Mara investing in the supplier money. Instead to take loan from banks, they invest in the supplier money. Here it is, they collect money after 25 days and give it back or pay to the supplier after 82 days. This means this period between the 10 to 25 days and 82 days, they invest the money in the market, the money of the supplier. Okay, the same with the inventory turnover. It's only 12 days, 16 days. This give you an indication this is only an inventory for emergency. Yani in case there is any emergency, okay, there is stock in the warehouse. But our example, it's big difference here how many days they stay in the warehouse. This is an introduction for the financial statement analysis. Inshallah, we're gonna to meet again in more details. Thank you for your time.